Hey everyone, thank you so much for joining us today for this unique webinar that we're going to be hosting with Sonic Power. For those who don't know me, my name is Chris Lustrino, and I'm the founder and CEO of Kingscrowd. You could think of us as kind of a Bloomberg Morningstar solution for actually rating equity crowdfunding deals. But today I'm going to be doing something a little bit unique. Spencer, who is a friend of mine and a neighbor in my co-working space that I've gotten to know over the last year and a half, is currently hosting a round on WeFunder. And he and I have been chatting about this round of funding for a good deal of time. And it's been really exciting to see him get ready to launch this raise. And so we decided to do something kind of cool today, which is we're going to dive in and go through his offering page and talk about his deal. And I'm going to grill him. And we're going to learn more about his deal. We're going to see the strengths, the weaknesses of the business, and hopefully help you in thinking through your investment decision. So with that, we're going to hop in here. Spencer, thanks so much for joining us.
Good intro. Yeah.
Wow. Thank you very much. I appreciate that.
Yeah. You're a natural.
Oh, stop it. Well, you should check out my podcast if you haven't.
Go on.
No. So what I want to do here, and this is actually something I haven't seen be done before, though I think it'd actually be a really good thing for more companies to do this, is actually kind of do a walkthrough of your offering page. And I'm going to kind of call some things out, some things that I get excited about, some things that I maybe have concerns or questions about. And help viewers really kind of get a better understanding of the deal, reading between the lines, right? Rather than just the facts that are on the page, let's dive into the unique things within the page.
Perfect.
So let's start off with every WeFunder page. I'm sure you all kind of know there's kind of those key highlights right at the top of the page.
Yep.
Now, one of the things that interested me in your company from the start, we look at a lot of companies at Kingscrowd, probably a couple thousand a year. Over a third of them have no revenues to speak of. Last year, in your first year of business, you did about $650,000 in gross sales, which is really, really impressive. So first off, kudos to you for having that type of success. But let's dig into those numbers and probably taking one step back. If you could give folks kind of your one pitch, your one-liner on your business, what is Sonic Power?
The one-liner that we're working with right now is LG for Gen Z.
LG for Gen Z. And just to be clear for folks, LG, right? It's like Samsung or any of those other ones. So you're saying consumer electronics for a new age generation.
Yeah, exactly. So electronics for a new generation, the internet's favorite electronics brand. We're working on a bunch of different titles. As you know, the one-liner, the Bloomberg for alt investments, right?
Yep.
Is really important. But the one I like big vision right now is LG for Gen Z.
I love that.
Yeah.
Now, the next thing I want to hit on, so LG for Gen Z, 42 million unique social media interactions. So going to this whole Gen Z vibe, it sounds like you're marketing to the right space, because one thing I can imagine is trying to break into a category with very large old incumbents like LG and Sony and Samsung. That's pretty hard to get people to switch and buy another brand. So talk to me about what your marketing strategy has been and how you've been able to get so many likes and virality on social media.
Yeah, so far our marketing strategy has been to focus on our best sellers, the ones that go viral, our electric scrubbers, which you can see over there.
Yeah.
Stuff that really builds awareness and loyalty. People love posting it. So that's grown the brand from nothing to 42 million, as you heard. So that's where we've focused, but we have big aspirations. As you said, it's like, how do you become the new electronics brand, right? LG makes everything. Think like LG, think Philips, think, Sony. All those brands have been around forever. But, I think with this new generation, there's huge opportunity, for a new, fresh player to come in. R&D costs are way down from a manufacturing standpoint. So we can really slide in and create a market and steal market share away. I don't even know if it's stealing market share away. I think we're going to get to the point where some people are buying their first big purchases right out of college, even in college. And we're going to be that electronics brand for them from, the beginning of their journey to, when they're, 60, 70, 80 years old. So I think we're coming in at the right time. So first mover advantage for us is really important. We're the only ones focusing on this type of business model, as far as I'm aware. I think it's an exciting time.
I think part of what you're talking about here is like it's about building a brand and an authenticity that gets people to be excited about buying Sonic Power over these other brands. Coming into such an established category, I'm just curious what kind of the inspiration honestly was for all of this.
I've been in electronics my whole career. So I started at the manufacturing level in China, doing sort of small parts for big projects. So think like, headphones for the Apple. Remember when they would ship headphones in box? I was a part of that from the manufacturing side, not working for Apple, but working for manufacturers. Quickly transitioned to more of a product role at Magic Leap, which was this high-flying startup, and then got back into more of a consulting role in the electronics manufacturing space before I started Sonic Power. So I've always been around consumer electronics.
Got it.
Loved
so you
gadgets.
kind of saw the market gap. You understand
it was
where
obvious.
the pain points are.
It was like, no one cares. You walk into someone's house. The easiest way to understand the space we're sliding into is no one really cares what TV you have anymore. It's all democratized.
Right.
And that goes across TV, earbuds, speakers, kitchen gadgets. They're all the same. Mm-hmm. They're all coming from the same factories. These big name brands, no one really cares about the brand anymore. So we want people to, because they care about price. Right. And Amazon. So we want people to still have that same, price, awareness, but care about a brand a little bit more. So not buying XYZ because it's priced low, buy XYZ because it's priced low and it's a brand you care about.
It's kind of cool. Yeah. Now, I think something we've seen in the past several years is that direct consumer DTC, good model, but has had its struggles.
Yeah.
So ironically, it turns out still working with retail is one of the key ways to ensure that your business will have a lot of success if you're a consumer good.
I would say it's the key way.
So Target.com, let's talk about that. You have Target.com launching Q1 2024. I think this is really important. Tell us more about what that looks like.
So we pitched our electric scrubber, which is the one that's really made us famous, I would say, online.
Yep.
To Target. They saw us and they invited us to do a pitch last summer, which we did. And they said, well, this is going to be the most premium product in our category. We're going to slow play this a bit. So we want to start you online, see how it goes. And then if we see what we think we'll see, we'll put you in stores for 2025. So that's where we are right now. We're in the phase where they're going to test us on Target.com, which is a big deal in of itself.
Yeah.
We're going to push that really hard from our side, from a social media perspective, influencers perspective. Hopefully hit the mark and then go online. So we're also redesigning our packaging, making more of an out-of-box experience, creating really an ecosystem around the scrubber to show the Target we're ready for retail, because that is where you do a ton of revenue and a volume, and it builds legitimacy across all the categories. So I'm really excited about that.
Imagine turning over tens of products in thousands of stores on a daily basis.
Yes.
It could be really, really impactful. That's exciting. Let's just talk about some of the challenges that come with going into retail. So
sure.
It's really, really exciting. What can you do right now that can mess up your opportunity to be in that channel?
Quality, number one. We've proven that our product is great, as far as customer experience, it works. But if, you get to the high volume, 10,000 orders, 10,000 piece orders, 20,000 piece orders, million piece orders, that's where you want to get. You got to control quality. Mm-hmm. So we're going all in on that with the scrubber in particular to make sure that's buttoned up and we don't have any issues with Target, because that's where they say, oh, you're not ready. Your quality's not ready. We need to put this on the bench. So that's where number one reason why things don't work out, from my experience. Got
it. So I'm looking at your offering page here, and I'm scrolling down to where you're talking about the power scrubber.
How does it look?
It looks pretty cool. So let's talk a little bit more about the power scrubber. I actually don't know much about this product. How are people using this, and why did it go viral? Yeah. I see Good Morning America, CBS covered it. Why did this go viral?
I think our hypothesis is, and it's more of a, we're starting to prove that out, is it's going to be the next household cleaning staple. So think Swiffer Wet Jet. When you think about the electric scrubber, scrubbing by hand is very old school. We have electronics now to do that for you and to do it 2-3x speed you used to. Not only is it faster, it's more effective. There's more use cases. It's fun. It kind of makes cleaning a little bit more fun, which cleaning's never fun. So yeah, I mean, there's a lot of reasons why it's taken off. People also love cleaning content in general online. Another big space is like mowing. People love like mowing content. There's these like relaxing type of content out there, and cleaning falls under that. So there's a lot of reasons why it's done well, but in general, it's just a great product. So we did 17 products last year, and it was the clear winner. And I kind of had a hunch from the beginning it was going to be, but you never know until you launch it. I thought some other products were going to have more legs than they actually ended up having. But we learned a lot. So the scrubber, people love it. There's many different reasons why, but people love it.
I do recommend, if you haven't, go on TikTok or Instagram and watch these cleaning videos. I think you could just look it up and find it. It's amazing. These videos have millions of views of people just watching people clean pans and clean their house. And in some ways they are satisfying. I actually kind of get it. I don't watch a lot of them, but like I understand the concept. Yeah. And it's certainly something that's gone viral in a way in which people choose to make buying decisions, which is really interesting. Now, I scrolled down to kind of the channels in which you generated your revenue in year one. 85% was Amazon. That's very heavy on the Amazon channel. I have heard folks who've struggled with the Amazon channel where suddenly they change the algorithm and now they're not getting any sales. What are your thoughts about expanding outside of that channel? And what has been successful within the Amazon channel that you do want to lean into?
We drive all of our traffic to Amazon externally. So mostly on socials. We're going to begin to drive it on more traditional media. We hired a PR agency this past year. So in 2024, we'll have a traditional PR agency to run ads, articles in GQ, Vogue, a lot of the big name brands. But we drive traffic to Amazon externally. So the algorithm changing doesn't matter to us, which I think is a strength. Some people really get lucky with the algorithm, and that's great. But I think relying too much on the algorithm, either in social media or in Amazon or any platform you're on, is risky in the long run. As far as other channels, that's our focus for this year as well. So I wouldn't say we've mastered or figured out Amazon. It's always a changing thing, but we know what to do there, and we know how to be successful now and in the future. So Shopify is another one that you kind of have to start to figure out a strategy for. That's direct to consumer, your traditional .com. We have sonicpower.co. Still working on buying the .com domain. A Chinese manufacturer, which we have a lot of connections in, as you can imagine, owns that domain. Huh. So we're having those conversations. So hopefully we'll get .com soon, but right now it's .co. So for their traditional PR, affiliate PR, influencer gifting, offline sort of traditional billboard. We're trying a lot of different ways to drive traffic to our site, but it's a lot more difficult. There's not a built-in sort of trust and ecosystem that Amazon has. So you really have to come up with a unique out-of-the-box strategy for Shopify or D2C, which we're working on now. And then all of that, both Amazon and DTC, flash sales. You talked about Good Morning America, which I think a lot of people are aware of. All that will feed into our sort of target strategy as well, and our wholesale retail strategy, I think. So it's an ecosystem. We think about all these channels as an ecosystem, but like different worlds. So like we have a completely different strategy for Amazon as we do DTC, as we do pop-ups, as we do retail flash sales. So there's like there's like a strategy with each of these worlds, but they all feed into each other in the long run.
The pop-up, I'd love to hop on this one. So this past holiday season, Spencer ended up opening up a pop-up shop actually in our local mall, which is one of the most well-attended malls I think in the country. South Point Mall, for whatever reason, is a really high-traffic mall. And basically set up kind of like, you know, the Halloween costume shop, but he did that for consumer electronics for gifting at the holidays, which I thought was a really interesting concept. I think we were both excited about it to see what would happen. And I think
Everyone was very excited.
everyone was very excited about it. And it was kind of around
People
that
are always saying,
concept.
congratulations. I'm like, we
Yeah,
haven't
you're
even
opening a
launched yet.
store, right? That's exciting. And it's like the whole beating the algorithm and going the retail channel. But unlike Target or even Amazon, right, where they have these established brands, you know why you're going there and what you're going to be purchasing. I think you learned some things along the way with the pop-up. So what was that experience like? What was the good, the bad, and the ugly?
You tell me first. What was your experience like?
Well,
you were there.
I personally thought it was really cool. And the night before the holidays, obviously, I had an affinity for the brand and being tied to you. And I think that's a big part of it, right, is building an affinity for the brand and people knowing that you're there. But I needed a last-minute gift, and I knew where to go, and I ran in there 10 minutes before the mall shut. So I actually found it very helpful having it there because you couldn't order it online and have it, you know, at my house for the morning.
Yeah.
So I actually really loved it. I thought it was really cool, but I think you learned some interesting things about how people shop and that they're not necessarily going to a mall to shop for electronics, right? They're going for clothes. It tends to be more of a female buyer. So that was an interesting learning. And I think, you know, that was kind of what I took from it.
No, I learned so much. I'm still like trying to unpack that experience because there was so much learning in it, and it was almost too much at the same time. I would say the main takeaway is that malls or retail in general, a retail footprint is extremely hard. Mm-hmm. It's necessary, so you just have to keep kind of drilling down. We're not going to go away from that model at all. We're going to keep trying to figure it out. You got to figure out your model. We did an inline store kind of, so like we got compared a lot when people would come into Sharper Image or Brookstone, which was, you know, I agree.
The right idea. Yeah.
More useful products than them. Theirs was more of like gimmicky kind of fun things to play with, but that's what brought people in. So one, you need a way to get people in your store. People don't just come into your store because you're in the mall. I mean, that's what you think will happen, right? And we thought that would happen. We thought that would happen, but no, you need ways to get people in.
Yeah.
So that's why Sharper Image had massage chairs. When you really think about it, they weren't selling a massage chair. They were selling the experience of people coming in and sitting down, and then once they're in, looking around, maybe buying something that's $20.
Huh.
So
I never thought about that. It's a really good point. Create the experience, draw them in, and then get them to buy the.
Yeah. So what we learned is it needs to be an experience. So next time we do it, it's going to have to be more of an experience. There's going to be a reason for people to come in. They're not just going to come in and shop for gifts. We went heavy on the gifting, as you said, because we thought being there in November and December, that's what people are going to be looking for.
Right.
But even Black Friday was like, it was surprising. Everyone was looking for cheap clothes. It was like teenage girls looking for cheap clothes. Is what Black Friday is now. So it's completely changed. It's not people in Macy's no one's shopping for Christmas on Black Friday. I mean, at least in that mall.
Yeah. Well, what I like about this is you're thinking about a multitude of channels in which you can sell, partnering with the big players, also not beholdening yourself to the big players, and also keeping your fixed costs low by, you know, doing pop-up shops. Instead of saying we're going to have our own retail stores full time, you said, hey, we'll do this for 2-3 months and then we'll be out of that lease, which I think is a really good move as you're learning about the retail channel. But I'm glad to see that you're diversifying out of just being an online D2C, which I think, again, is kind of a dead model that everyone's learning doesn't work over the long term as you scale.
I wouldn't say it doesn't work. I would say it's harder than people think. People think you just put up a site and you're selling things. No, it doesn't work like that.
Yeah, and the level of profitability is challenging. All of those things are really hard.
And we should talk profitability.
Yep.
So this year, our goal is to sell 100 scrubbers a day. That's profitability for us. We're thinking it in simple terms as sell 100 scrubbers per day. That covers all costs, gets us to pretty much break even, a little bit profitability. And then from there, it's gravy. So when we think about our strategy this year, it's really scaling the scrubber, our bestseller, to a break even profitability point. So I think it's important to note on that topic of profitability, when you think about investing, we're thinking that top of mind. It's how do we become profitable this year? Not how do we scale it as quickly, as crazily as possible, like the old CPG consumer model, and then figure out profitability later. How do we figure out profitability right now? And I think we'll do it. I mean, I would be very, very surprised if we're not having a conversation for a year from now that, we're not at least very close, if not blew past, our 100 scrubbers a day.
Well, I mean, I think your 2024 forecasted revenues are robust, and I'm seeing $1.8 million. But to your point, if you could kind of keep Amazon where it's going and grow that a bit, lean into the Sonic Power channel specifically to your own site, increase on your flash sales and get Target going, again, to that multi-channel strategy that you're taking, I think you're creating a real opportunity to do it. Now, you still have to execute and people still have to buy all of those things, but I think you're taking that right approach. One of the other things that I get excited about is, yes, there's Target, but you could go beyond there as well, right? So talk to me a little bit about your long-term scaling thoughts and entering other retail channels.
Sure. I completely agree, and I'm glad you brought that up, is the reason why we focus so much on Target is, one, they are the ones that noticed us, and we're most excited. So obviously we're going to double down there. But the retail space sort of takes their lead from Target for the most part, whether they want to admit it or not. Target has always been innovative with bringing new brands in and not scared to take on new brands and prop them up and help them out, especially in the consumer, goods space. And consumer electronics, it's fairly new, but I think that is probably what's exciting to them about Sonic Power. So yeah, we want to figure out Target first, so the rest fall. Next will come Walmart. Bed Bath & Beyond is doing some new stuff. They've recapitalized. They're back at it. The Home Depots, the Lowe's, our cleaning products are perfect for them. The possibilities are endless, but if you nail Target.
Looking at how you plan to kind of spend the funds, a big portion of it, right, really comes down to two things: inventory and marketing. Anyone who hasn't run kind of a consumer goods company, I think the biggest challenge that people don't realize is that inventory aspect. The fact that you have to pay for the inventory before you sell it. You have to produce it, so when people want to buy it, you actually have the inventory to sell. What has been your strategy for kind of managing your inventory? Obviously, that's one of the biggest hiccups that consumer goods companies run into is buying the inventory, not selling it quick enough, running out of money. So how do you think about managing your inventory strategy?
Last year was way different than it's going to be this year. So last year was figuring out our best sellers, using data and both quantitative and qualitative data to pick products we think are going to be winners. We found a few that are just clear winners: scrubber, car vacuum, a few others. This year, it's doubled out on those from an inventory perspective and clear them out as quickly as possible. So when we think about how quickly we want to clear them out, for every buy we do of a product, we want them out. We want all of them out the door within 2 to 3 months max. So every quarter, max, out the door, shipped to a customer. From a cash flow perspective, obviously that's why we're raising money, to make that a little bit less stressful. But we do buys in the 5 to 10K pieces range right now. Last year we did about 1,000 piece orders per to keep the risk low. This year we're going to ramp it up since we're focusing on some clear best sellers and products that clear through quicker.
I want to talk a little bit about overall market opportunity. I think you and I, before this started, we were talking a bit about it. So When I think about overall market opportunity, I kind of think about it in two ways. I think as overall market, and that's, hey, consumer electronics is a $1 trillion category. But then for me, it's really thinking about what's actually addressable. So right now, I really kind of think of your business as more kind of the consumer electronics focused on the kitchen space. And then within that, you're not, the large consumer electronics like the ovens and the refrigerators. So I think there's many billions there. I think it's far from a trillion. And then within that category, I think, there's hundreds of millions of dollars worth of opportunity, but maybe not billions and billions of dollars of market share. So talk to me how you think about market opportunity.
Yeah, I hear you. That's why I'm leading now with LG for Gen Z, because that's big vision. Right now, for us to say we're going to make TVs and refrigerators and all that is crazy talk. It is. You need a ton of capital, a lot more R&D than you think, but it's not as crazy as you think, given how things have changed from a manufacturing perspective. Like I could buy an off-the-shelf TV right now, and start selling it. That you would think is an LG. I just don't want to commit from an inventory. We're not raising $10 million right now, but when you think long term, that's why I'm saying LG for Gen Z. So when you think market cap and total addressable market, that those are big guys. So. No, it's not a trillion for us. Well, the total market is around $1 trillion.
Yep.
But for us, addressable, it's in the billions for sure.
When you think about exit opportunity for investors coming into this round, what are you thinking about? Is it acquisition? Is it going the long distance to an IPO? I know founders like to keep all their options open, but I'm curious what you think about that.
Yeah, so when you get to a certain point in consumer electronics, you'll most likely get an offer at the $100 million level. That's where you start to get offers. So you need to get to a certain revenue point. Anything less than that, you don't see as much activity. Mm-hmm. So when you think about exit strategy, I think you'll see a $100 million exit. We'll consider that for sure. Long term, though, if we hit the mark, if everything goes to plan, if we're able to capitalize the company properly and really hit things in the right way, the right time, going public would also be another option for sure. But also, I was talking to you. It was like, why not? Why can't a company in the future do a quote unquote public public offering, but in the private market, like in Funder, will there be 100 million? Will there be a $1 billion WeFunder campaign? I think so. If this thing continues to go in 20 years, 10, 20 years.
No, I think that's right.
Isn't that something that's possible? You can't make a ton of money on the stock market anymore either. Unless that's why a lot of people want to invest in startups, which is again why I want to do a WeFunder campaign. I want to get in the space and build a community. That
makes a lot of sense. So something that you're not allowed to do in a Reg CF campaign, for better or for worse, is you can't specifically call it the terms. But I'll just mention, if you look at the terms of the current raise, I think they're fairly reasonable for a company like this. Truthfully, I think they are right price, and you and I talked a lot about pricing before you went live. I think it is a fairly priced opportunity, and when you think about, hey, $100 million exit, yes, there's going to be further dilution in the future. You're going to have to raise additional money to really scale up and go into new categories, but it is fair and reasonable. One thing I do want to call out for investors is, if you go and look at their financials, the way that Reg CF works is you have to file 2 years of financials that are created by a CPA. And the way that works is basically you have until April 30th of any given year to file the most recent year's financials, because it takes time to close your books out. So what you're going to be looking at when you look at his financials is actually the financials of almost like pre being a company.
Yeah,
it's going to be much. 2021 and 2022. 2023 financials will be filed after April 29th of this year, which means that when you look at those financials, you're looking at 21 and 22. You're not looking at 2023 when that $665,000 in sales across, their first 12 months of business actually occurred. So I just want to help you understand why the numbers you're seeing on the page aren't going to line up necessarily with what you're seeing on the financials. But there's no nefarious things. This happens with a lot of companies, and everyone kind of struggles with, how do I represent that before my financials are ready from my CPA? So I just want you to know that as you kind of dig into the financials. But one thing I do want to hit on with that is, talk to me a little bit about what your gross margins have looked like, and what are kind of the weaknesses in still not being scaled up. When you think about profitability, you think, hey, within the year you can get there.
Yeah.
But you're still at a relatively low volume, which means the cost for manufacture is going to be higher. So how are you managing your overhead?
Yeah, gross profit hovers around 30%.
Which is about right for a consumer electronics company.
Yeah, it's
right?
good. It's very good. That should go up now that we've or more focused approach on our best sellers. Sorry, what was the?
So understanding your gross margins, we hit on that. And then the second thing I'd like to understand is just managing your overhead. How do you think about getting to profitability? What are you doing to ensure that?
So we've taken some bets, I think are good bets. So we hired a PR firm. That's 11. Shouldn't say that. We hired a PR firm. We're doing a lot of influencer gifting. So we're seeding, the space. There's a cost there. So we're taking bets right now in the Q1 that we are very confident will pay off in Q2, especially Q3 and Q4. So as far as managing cash flow and spend, a lot of our spend is right now up front, and will pay off in the latter half of the year. And we're very confident. Like, a lot of that was based on learnings from last year. So we were okay to make those bets and sort of, be more strategic about products and more focused. So I'm feeling really good about it. That's sort of why I'm already talking profitability. And that's crazy. That could be crazy talk, but feeling really confident.
Last thing I want to hit on here, consumer electronics, it's an interesting category. I think for many, it might not be the first thing that jumps off the page to you, right? You're looking for software companies or AI companies, whatever it may be. What about the positioning of this deal do you think makes it interesting to investors? Why should someone click invest?
Would you invest in LG, Sony, Philips at a $5 million valuation? Knowing where they are now, 20 years previous? Yes, you would. Hello.
All right. Enough said. I think that does the trick. Well, for folks who are interested, you go and check out their page, or if you're already on it, and kind of walk through as we did here today. But Spencer, thank you so much for your time and your thoughts, and good luck on the race.
Thank you, Chris. You've been a big help. So I just want to say thank you so much. I think you are a tremendous resource to this whole space, and I think we owe a lot to you. So thanks again.